If you think about inflation, it is what is driving financial returns for majority of the people that are making money in the market today. It is also the thing that is driving many of the people who are actually going into a worse financial position at the same time. Inflation is the key to finance and investing right now. Now, as we talked about yesterday, the CPI number hit 5.4% in June. That's the highest it's been in 13 years. If you take out the food and energy sectors, the core inflation number is 4.5%. That's the highest it's been in 30 years. We are at historic rates of inflation during most people's lifetime that are watching this show right now. It is so bad that you can see here, the New York Post, this is the front page of the New York Post, the incredible shrinking dollar. And all they're talking about is inflation. You can also see down here in the corner that inflation was trending on Twitter yesterday. The mainstream population is waking up to the fact that the dollar is getting crushed. People who get paid an hourly wage get paid less today in purchasing power terms than they got paid a year ago. It's on the front page of the New York Post. The front page of the New York Post is reserved for the juiciest gossip or reserved for absolutely historic moments. And so to have the incredible shrinking dollar on the front page of the New York Post is pretty incredible. Now, don't take this just from me, right? I'm just some random guy on the internet. So are my brothers. What do we know? Let's look to the people who are paid millions and millions of dollars a year to navigate economic situations, economic environments, to be experts in monetary policy and to understand what is happening in financial markets. First, we can start with Larry Fink. Larry Fink gave an interview this morning to CNBC. He had a ton of super interesting comments. And so if we go first to the first quote, Larry Fink said, "The silent crisis of retirement. Unquestionably, as central banks keep rates low or negative in Europe, the savers are getting slammed. Asset owners are the biggest beneficiaries of monetary policy." This is what we talked about yesterday. Savers are losers in today's monetary policy environment. The people who are making money are the investors, people who own assets. So inflation is driving up the asset prices and enriching people who are investors, and it is punishing the savers. Fink then went on, we've got a second quote from him, where he said, "I think, as you remember, on your show a number of years ago, I was asked what should be your asset allocation. And I've always said 100% in equities. We are going to have to address what I call the silent crisis of retirement." So Joe and John, how crazy is the monetary environment where monetary policy is driving somebody who's considered fairly conservative like Larry Fink to say that 100% of your portfolio should be invested in equities?
It's wild. I mean, it's absolutely wild, right? You think about historically, it's go buy gold, go buy commodities, real estate, get some bonds, collectibles, whatever it is. Now it's 100% equities. 100%.
It is wild to me that the head of BlackRock, the CEO of BlackRock, is literally sitting there talking about you should be 100% allocated to equities. And he said that he's been saying it for years. And he clarified, he said, look, I didn't know that COVID was going to happen. I didn't know that they were going to do all this stuff. But to have 100% in equities, most people would almost call that irresponsible. Right? Yeah. But now it's literally on national television. We're being told by the head of BlackRock that you should have 100% allocation to equities. It seems to me that all these young kids that are fully invested, they actually may have been ahead of the curve. He went on, he's got a third quote that I think we've got here where Fink also said, we're going to pull it up here. Give us 1 second. In this interview, Fink said, let's go to the next one. This is the equities. All right. So I don't know what happened to the other quote, but basically what he said was that folks are going to continue. If you are a saver, you're going to continue to get absolutely crushed. So then he wasn't the only person that gave an interview today. Then we've got Treasury Secretary Steve Mnuchin, who I never say his name correctly. How do you say it?
Mnuchin.
Mnuchin. If I just say it enough times, we'll just say Mnuchin. All right.
Say it however you want.
Before we forget who Steve Mnuchin is, we got a photo. This is the most legendary photo ever of Steve Mnuchin, who I'm going to continue to say his name wrong. That we're gonna pull up here. In this photo, to me, it's not so much just him; it's actually his wife. right? That makes this photo.
Oh, it's a legendary photo.
Yeah. That is an all-time photo.
The smirk, her stone cold face with the gloves on.
As they're holding
cash.
Printed $1 bills, right? And actually what makes the photo even better is the guy in the background a little bit. So Steve, he has this amazing photo that's on the internet. But today he was on and they were asking him about inflation and a number of other kind of topics. And he had some really interesting things as the former Treasury Secretary. If we can pull up what that quote is, I'll read it. But basically what Steve said was, he said, I respectfully disagree with him being Jay Powell, the head of the Federal Reserve, on his not being concerned. We've seen inflation numbers that are in the 4.5% to 5.5% range. I think the Fed's policy of going over 2% inflation made sense before COVID, but the Treasury models and the Fed models can't really predict what happens after this massive amount of fiscal monetary response. So hold on a second, time out. Big TO, big TO that I've got going on here. The former head of the Treasury just said that the Fed and the Treasury models are broken. The monetary policy and fiscal policy has broken the models. They cannot account for where we are. We are in uncharted waters. Should we be concerned about this?
Yeah, I mean, he's saying we just printed trillions of dollars and we have no idea what it's going to do, really, right? Like, he's saying the models don't work, and he knows, right? He obviously knows.
He was the head of the Treasury.
Head of the Treasury. It's crazy.
I mean, to say that the models are broken, to me, is absolutely wild, because what it's starting to say is it's pulling back the curtain. It's starting to show people, wait a second, we took actions that address the short term, but we don't know what the long-term impact of that is. And therefore, if the models can't account for those actions, we may be in trouble. We may not be in trouble. We don't know. And I think a lot of folks in financial markets always just kind of say, oh, of course the Federal Reserve, of course the Treasury, of course folks that are in the incumbent organizations, they know what's going on. They're experts. But if COVID taught us anything, it's that the experts have no clue either, right? I don't have a clue, but neither do they. All we know is that it's a probabilistic type outcome. And so when the models are broken, when the models can't account for what's going on, there's tons of uncertainty and it scares the hell out of people. And so rather than be scared, you should be educated and then you can navigate the markets. Now, the second thing that Mnuchin said, which I'm still not going to say his name right, is he said, quote, I think it is important for the Fed to get ahead of the curve so we don't end up with 4 or 5% interest rates, which could really slow down this recovery. Now, what's fascinating about this is we're currently in a 0% interest rate environment. And so they did 2 emergency rate cuts last year. They brought us to this 0% environment. In Europe, we see negative rates, but he's worried about the exact opposite, is that inflation gets so high that all of a sudden the Fed is going to have to step in again, and they're going to have to drastically increase interest rates to try to taper that inflation. There's a lot of countries around the world that have been in a situation that's similar, and they say, oh, if we get high inflation, we'll deal with it then. But I think that we've figured out that in a lot of these cases, they end up being unsuccessful, right? Lebanon's a great example where literally the Lebanese pound has fallen off a cliff because the central bank made bad decisions and then it just spiraled out of control. Do you guys worry about that at all?
About inflation running too high?
Yeah, and them not being able to actually curtail it.
Yeah, I mean, look, it's already at, 5.5%? Like, Jesus. And I was dying laughing when we were talking about this yesterday. It's like, as long as you don't need transportation, food, energy, housing, everything's all fine. We're close to 2%. It's healthy, right? And it's obviously a concern, right? It's already at 5.5%. There's only so many tools they have in their toolkit to be able to use to reduce it. So yeah, maybe people keep saying it's transitory or whatever it is, but it's already getting high, right? So when it gets hot like this, there's only so many things you can do to curtail it.
It's crazy. Here's the best part. Jim Cramer, we've got a quote from him. Somebody recently asked him what you should do. So, okay, inflation's high. It's likely to stay high. Powell thinks it's going to stay high. BlackRock thinks it's going to stay high. Everyone thinks it's going to stay high. They say it's not inflation. It's not transitory. Jim Cramer said, if you want one industry that's immune to both inflation and a Fed-induced slowdown, well, it's big cap tech. Hyper-growth tech stocks are actually what works best during a slowdown. This would have been nuts 5 years ago. If you had said, hey, we're going to have high rates of inflation and therefore investors are going to go find safety in big cap technology stocks, right? They're going to go buy FANG and that's going to be the inflation hedge. But if you look at what Jim Cramer's saying and you look at what Larry Fink is saying, they're saying the same thing. Larry Fink says, hey, get long and shut up.